Okay, so last time we were here, we were talking about the different types of bonds. And we're going to talk about some called zero coupon bonds. And we mentioned them just a minute or so in the calculations. We said that all zero coupon bonds, unless we're told otherwise, we treat them as for shame, he's late. We treat them as semi-annual coupon bonds, which means that they pay zero coupons twice per year. And the only reason that matters is because of compounding, because you're compounding that interest twice a year. Okay, so those, you've got a little bit of idea of those. So here's the idea with these. All the principal is paid back, all the principal and interest is paid back at the end. All of it's paid back at the end, which means that they must always be a discount bond. Actually, I created this slide before the last financial crisis, and during that financial crisis, the yield to maturity on some of these bonds actually went negative. Why in the world? How could that happen? So let's think about this. Recently we saw the Silicon Valley Bank went belly up. We had people who had money in there far in excess of the $250,000 FDIC limit, and they very much could have gotten burnt over that, except for they got a bailout. Now, think about where people like that could have stuck their money to avoid potentially getting burnt. And the big answer is into treasury bills, treasury bonds, that sort of thing. And so you wind up with people actually bidding up the prices of this sovereign debt. The Germans are the ones that I remember the most. People were bidding up the price of their debt such that the yield to maturity went negative. And they are actually basically paying the governments of these countries to keep their money safe. So it's kind of like hiring a security guard to watch your treasures, right? And so that's the only, I throw that out there because they don't always have to be a discount bond. In weird situations when yield to maturities go negative, they can be a premium bond. Now we have some other names for these. We call them zeros or deep discount bonds. You can have a discount bond with coupons that are slightly less than the yield to maturity, but you know these have to be a deep discount because zero is usually way lower than whatever required return is being required on these bonds, and therefore they're going to sell at a pretty steep discount in normal times. Questions? What's riskier, a zero coupon bond? What's riskier for you to own, a zero coupon bond or one that pays coupons along the way? Yeah, a zero coupon bond because you are totally dependent on them doing something 10, 20, 30 years out, right? Things can change, so that makes them pretty risky. Okay, now let's talk about floating rate bonds. If you remember, I told you that the coupon rate on a bond, except in weird circumstances, stays the same over the life of the bond. This is the weird circumstance. If it's a floating rate bond, then that rate can actually change too. So here we are. We've got this coupon rate, and it's in the indenture of the bond, and it's spelled out as the coupons are the yield on the current 10-year treasury note plus 2%. That's so they're going to use some sort of base. And the idea is to get the coupon rate on these bonds to float at about the same amount that the yield to maturity will. And if it's successful, the coupon rate will be equal to the yield to maturity. What does that mean for the price of the bond? It will always be close to, it's always going to be close to par. And so the floating rate bond does something pretty cool. It takes the interest rate risk off of the bond holder and puts it on to the bond issuer. Think about a regular coupon bond. If interest rates go up, the value of the bond goes down, the bond holder gets hurt. If you've got a floating coupon, the yield to maturity goes up, the coupon rate goes with it, the price stays really close to that face value. And so that interest rate risk is transferred from the bond holder to the bond issuer, because now when interest rates are up, the bond issuer has to pay more. Of course, there's also the chance interest rates go down, they may not have to pay as much. Now, If you are transferring risk off of the lender and putting it on the borrower, what would we expect to happen to yield and maturity as a result? So if you're transferring risk off of the bondholder, they're not going to require as much yield to maturity. So a floating rate bond should actually have a lower yield to maturity, all things equal, than a regular fixed coupon rate bond. Okay, now you can think about this being like adjustable rate mortgages. When I borrowed money for my house, I got a fixed 30-year rate of 3.375%. Do you think that the lender now would have been pleased if I had borrowed money on a floating rate instead? Oh yeah, right now they're getting 3.375% and they're having to pay more than that for the money that they're using to fund the mortgage. So the adjustable rate mortgage, when you go out and look at those, usually the interest rate on the adjustable rate mortgage will be lower because you are transferring the risk off of the lender and putting it on the borrower. So as a result, the borrower is not going to be willing to pay as much interest and the lender is not going to demand as much. So it's really the same idea. Now let's talk about you and financing your own house. You probably think that the 30-year fixed is the gold standard, and it is, but how many of you will actually live in a house for 30 years? Yeah, it's pretty rare, especially your first house, that starter home where the kids first show up and whatnot. Chances are you're going to move out of that thing at some point. And so if you're only going to be in there for, say, 5 years, it makes sense to get one of these adjustable rate mortgages that's the same rate until 5 years, right? And you're going to get a lower required rate as a result. That makes sense. Now, the downside to that is, what if you get stuck? What if you get stuck and it comes around, 5 years are up, interest rates are through the roof, and now you end up making those higher payments. So that's the potential downside, but just something to keep in mind when you go out shopping around for a mortgage. Okay, let's talk about income bonds. An income bond basically says we're only going to pay the coupons if our net income is at or above a certain level. We're only going to pay the coupons if our income level is at or above a certain amount. Now, this is crazy. I would tell you to stay away from income bonds. Don't ever buy an income bond, and here's why. Managers have a whole lot of discretion under the generally accepted accounting principles on recording expenses and things like that. And so basically, they can manipulate earnings down to keep them just below the level that would trigger a coupon. And if you don't believe me that managers think that way, just wait till you've been out in industry for about 5 years. You will figure that out pretty quickly. We would have bonuses that would kick in at, let's say that they would kick in at 100, and they would say, 99, right? It was always just that close. And there was no rounding up, right? Just like my class, there's no rounding up. Okay, so what these people are going to do is they're going to manipulate their accounting, even within legal bounds. They can manipulate their accounting to make sure that you don't get your coupons. In fact, we've only seen these be big one time in American history. When the railroads were dying back in the 70s, they started doing this. And once is enough. We're now smart enough to know not to do this. In fact, a famous finance professor once said that these income bonds have the smell of death about them. What does he mean? He means companies only issue them when they are sick. If they were healthy, they would be issuing regular bonds that we all know and love. Questions? Okay, now let's talk about convertible bonds. Convertible bonds. So bonds are a debt instrument. And here's the thing you need to know about regular, or what we would call straight debt. And that is, there is no upside. There is no upside to straight debt. I'll walk you through it. In normal times, they pay out their coupon. Boop. Times get a little better. What do? Pay out their coupon. Things are really great. What do? Boop, pay out the coupon. The best you're ever going to get is that they pay as promised. The worst that you're going to get is that they default. Does that make sense? And so there's no upside to owning debt, there's only downside. But what if we could come up with some sort of debt instrument that along the way we could convert into stock? Then that would allow the debt holders to take advantage of those good times. Does that make sense? Because we can take this debt and we can exchange it for stock, and now the stock price does have an upside. Now let's talk about how that works. I would say if my stock is currently trading at $20 a share, what I would say is you can exchange one of these $1,000 face value bonds for 40 shares of stock. 40 times 25 is 1,000. And so basically, it's not in the interest of the bondholder right now to go ahead and convert into the stock. If they wanted the stock right now, what they should do is go out and buy the stock at $20 a share, right? They could save themselves $200. But we can sell them this convertible bond, and it's basically got this lottery ticket stapled to it. What's the lottery ticket? What happens if that stock really takes off? I can convert my bonds at basically $25 a share. If the stock price is above that, now I can take advantage of that. Now you need to understand that conversion is a one-way street. You can't go backwards. You can't say, whoop, want my bond back. So this is a one-time thing. So what do? What you do is you wait until you're ready to sell the stock and wait for that and to convert the bond. And here's why. What if the stock price goes to 30? You convert, now you've got stock that you basically paid $25 a share for, it's worth 30. You're in the positive now. But what happens if they report bad earnings next week and the stock price drops down to 24? Now you're kind of out of luck. So what you want to do is to protect yourself against that downside that the stock has. What you want to do is hold on to that bond as long as you can and then convert it at the last minute right before you sell the stock. And that way you're not going to wind up with a bunch of losses if something weird happens with the stock price. Does that make sense? Okay, as a result, by the way, let's start off with this. We said that these things have a lottery ticket stapled to them. Are people willing to pay money for lottery tickets? Yeah. And it turns out that bondholders are willing to pay for this lottery ticket, and the way they pay for it is through lower yield to maturity. So these bonds, if a bond has a conversion option to it, it has, and everything else is exactly the same, it's going to have a lower yield to maturity. It's going to have a lower yield to maturity. Let me say that one more time. A convertible bond will have a lower yield to maturity than an otherwise identical regular or straight bond, simply because it's got that lottery ticket attached to it. People are willing to pay for that. Oh, phew. Okay. Any questions about convertible bonds? So let me put you in the shoes of the manager. You have the choice between issuing convertible debt and straight debt. When is it advantageous for you to issue convertible debt? When the investors think the company is getting ready to take off and you know that it's not, right? Because that allows you to go out and issue debt at a discount from your perspective, meaning that you're not having to pay as much for borrowing that money. And you don't have to worry about people exercising the bonds and diluting the current shareholders. By the way, what's the goal of financial management? Maximize shareholder wealth. Did we mention bondholders in there anywhere? No. Now, ethically, legally, morally, should we be screwing over the bondholders? No. But it is my responsibility to maximize shareholder wealth. I'm going to disclose all the things that I am required to disclose in this bond prospectus, and I'm going to lay out the risks. That's one of the things you lay out with bond prospectuses, the risks that are facing the company. If people can't read into that and understand that this thing's about to take a dump, then that's on them, not on me. Does that make sense? Okay, now let's talk about put bonds. Remember, a callable bond gave the bond issuer the right but not the obligation to buy back that bond at some point in the future at a certain price. Well, put bonds are kind of the opposite. A put bond, now this is, and people get these confused all the time on the exam, so be careful to write this down and have it both on your note sheet. The put bond gives the bond holder the right, but not the obligation. The put bond gives the bond holder the right, but not the obligation to force the bond issuer to buy back the bond. So the bond holder can force the bond issuer to buy back the bond. Now, it's going to be, instead of having a call premium, there's going to be a discount off of the face value. So let's say that you can sell the bond back at 1,000 face value minus 100. And so you can sell it back for 900. And so if you buy the bond today and the coupon rate's equal to the yield of maturity, we know that bond's going to sell at par. It doesn't make any sense for you to try to force them to buy that bond back immediately, because you just immediately lose $100. So when does it become useful to you to use that put option? The answer is if the bond price falls below $900. If the bond price falls below $900. And so let's say that the bond price falls down to $850 or $800 for whatever reason. In theory, we can force the bond issuer to buy back that bond for $900. In theory, this puts a floor to your losses. You'll never lose more than $100 on this bond. You'll never lose more than $100 on the bond. Now I say in theory, and here's why. Let's talk about what would make the bond price drop like that. If there was an overall level of interest rates in the economy that went up that made the bond price drop like that, you probably would be okay to get your bond bought back. However, what if something is wrong at the company that makes the company now extraordinarily risky? That's why the yield to maturity went up like it did, and that's why the bond prices are as low as they are. There's a chance that the company won't have the $900 to buy back your bond. And when you approach them to make them buy back the bond, at that point, it'll probably be bankruptcy. So we say it theoretically puts a floor to your losses. Does it protect you completely? No. Is it better than not having this put option? Yes. Now, since we are protecting the bond holders by putting a floor to their losses, as a result, do you think they will require a higher yield to maturity or a lower yield to maturity? Ms. Minahan. Lower, very good, because we are taking risk off of them. Therefore, they're going to require a lower yield to maturity. Now, this means that a put bond could be attractive for managers to issue. And it's the exact opposite of what we had with the convertible bond. If the world thinks, if the market thinks that your company's getting ready to take a dump, but you are confident that things are going to be just fine, then it makes sense for you to issue a put bond because it lowers your borrowing price, and you know you're not going to have to buy those bonds back because, after all, you're going to be in good shape. So it's just the opposite of the convertible. The convertible bond, everyone else thinks that it's going to take off. You're pretty sure it's not going to, and so those bonds don't get converted. On the put bonds, we are pretty sure things are going to be fine. Everyone else thinks it's going into the toilet. And so we can get a lower borrowing cost by issuing these put bonds. Any questions? So, callable bonds, put bonds, basically the opposite side of the same coin. Now let's talk about bond markets. Bonds are sold over the counter. So let's talk about where that comes from. By the way, do you actually have to walk up to a counter these days to buy a bond? No. When we say over the counter, basically what we're talking about is a dealer market. Back in the old day, you'd walk into the bond dealer, and the bond dealer would have their inventory of all these different bond issues there under the counter. And so when you bought a bond, they would pull it out and hand it to you over the counter. And so that's why we call them over-the-counter markets. You will never see an exchange. So you see the Wall Street, New York Stock Exchange, you know, where they ring the bell and everybody, yay, right? You don't see that for bonds. And it's because the bonds are basically sold through a network of dealers. And these dealers are all electronically connected. And those dealers are going to put up two prices. They're going to put up a bid price, and they're going to put up an ask price. The bid price is what they will pay for your bond. The ask price is what they're willing to sell at. Which one has to be higher? Yeah, the ask has to be higher because that's how dealers make their money. That's how dealers make their money. And so their ask price is always going to be a little higher than the bid. Now, keep in mind that there's interest rate risk out there. These people are sitting on huge inventories of bonds. And if interest rates go up, that's going to make the value of their inventory go down. Bond dealers are not in the business of making or losing money off of interest rate swings. And so they are going to hedge their inventories with futures contracts and things like that. They are going to hedge against that to avoid that. So basically, it narrows it down to where this bid-ask spread is where the money comes from, and therefore the ask price has to be higher than the bid. And we say that anybody who is holding an inventory and stands ready to buy or sell, we call that person a dealer, and we say that they are making a market. We are making a market. By the way, definition of a dealer, holding an inventory, standing ready to buy or sell. Does that fit the definition of car dealer, so far as you know about it? Do they stand ready to sell a car? Oh yeah. Or do they stand ready to buy cars? Yeah. Do they hold an inventory? By the way, Mr. Rosen, you seem confused about the buy cars. What about your trade-in?
Yeah.
Yeah, okay. Or one time, so I was buying a new car, and the dealer, it was some snotty German brand, they wouldn't take my Nissan as a trade with the kind of money that I wanted. So what did I do? I just took my Nissan down to the Nissan dealership and I said, what do you give me for it? They wrote me a check, right? So they do just purely stand ready to buy, even if you aren't trading in a car. Plus, as opposed to selling at a Craigslist, you don't have to worry about getting murdered and stuffed in the trunk. Okay, back to the story. So that's a dealer. Now, let's contrast that with a broker. A broker is someone who puts buyer and seller together. Do they ever take possession of the asset? No. How do they get paid? Yeah, commission. So that's the difference between this dealer thing and the broker thing is the dealer holds the inventory and they're making their money off the difference of what they buy it and sell it, and the broker never holds the inventory and they make their money on commission. Okay. Any questions so far? Yeah.
So for this, like, companies approach dealers to sell their bonds to them, and then those dealers then sell bonds to us.
Oh yeah, and it's not just companies, it's the government. There are these bond dealers in New York City, and basically whatever the government puts out, they're going to buy. But of course, they have to figure out how much they're willing to pay for it, right? You can actually go out there as a taxpayer, and you can buy them directly from the Treasury, but you have to bid against these other people. And my guess is if you win any of those auctions, trick is you pay too much, right? And so you'd probably be better off to actually go ahead and go to the dealer and take the markup from the dealer than to try to go in and get that on your own with your own brain power, right? Does that make sense? Yeah. And so that's what happens is when they issue the bonds go to the dealers and then you can get your hands on them from there. Good question. Other questions? Okay. Remember, if someone is making a market, it means they stand ready to buy or sell. And what that means is that you can always buy and sell these bonds. If nobody is making a market, then I have to go out and find someone to buy my bonds. I'd have to say, hey, Mr. Bernstein, I got this bond here. Would you be interested in that? Let's assume that he is. Now what do we have to do? We've got to negotiate a price, right? But if there's someone that stands out there ready to buy or sell, they got a bid and an ask posted, then they are making a market, meaning that you can sell or buy anytime you want. Does that make sense? Okay. Now let's talk about bond quotes. Bonds are quoted in percent of face value. Bonds are quoted in percent of face value. Bonds are quoted in percent of face value. And if I say that a bond is quoted at 99, that means the bond is selling for $990. Why? Because that's 99% of face value. And so what we've got here is the first column, maturity, is the date on which that face value has to be paid. By the way, can you tell this is an old picture because some of these bonds have already matured, but the concept's the same, so I never changed it. I've kind of grown fond of it. Okay, so that's your maturity date, and we've got them all the way from 2014 out to 2042. And the coupon rate is next. The coupon rate is also given as a percent of face value. The coupon rate is also expressed as a percent of face value. And in fact, it's kind of cool because if you remember back to our definition of current yield, we said that that was annual coupon divided by bond price. And that annual coupon is the coupon rate as a percentage of face value times the face value. And we've got the quoted price down here, which is the percentage of face value. And we can multiply by the face value. So far, I have not broken any mathematical laws. We know that the annual coupon rates are the coupon rate, or the annual coupon is the coupon rate times the face value. The bond price is just that quoted price, which is a percentage of face value times the face value. Now, what could I do with the face values? Yeah, I'm going to cancel them out, and that tells me that I can actually just get the current yield by taking the coupon rate and divide it by the quoted price. And so I could give you this on an exam. I could show you a quote and say, tell me what the current yield is. And you wouldn't have to go through all that crap math. All you'd have to do is take the coupon rate and divide by the price. Now, which price would you divide by? We've got a bid and we've got an ask. If you are going to purchase the bond, which one are you going to pay? You're going to go out there and buy that bond. Which one are you going to pay? Yeah, you're going to pay the ask. And so the bond price that I would use here to figure the current price, or the current yield, is the asked price. I would always use the ask price if I am figuring it from the perspective of an investor. Okay, so we've got the coupon, we've got the bid, we've got the ask. Oh, and by the way, look at the coupons. They are in 1/8% increments. That's typically the increments that we see. So you'll see 4.25, 4.375, and 4.5, but you won't see 4.42. You won't. So that's typically how those are broken down. By the way, why do we do weird things with eighths in the United States? And the answer goes back to the Spanish dollar. The Spanish dollar was a round coin that you could break into 8 different pieces. And so a lot of things were priced, including stocks, were priced in 1/8 of a dollar increments. And that 1/8 idea just took off. And so that's why you see it so many different times. Have you ever heard the shave and haircut 6 bits? 6 bits is 3/4 of a dollar, 75 cents. Does that make sense? Can you tell we've had inflation since then? Okay. So that's why those are quoted that way. But you can see that the bid and ask prices don't necessarily work that way. And look at the difference between the bid and the ask. It's tiny. These dealers are working on razor-thin margins. They're working on razor-thin margins. That's why they can't afford to take on that inventory risk. The next column is the change. That is the change in the price, also quoted as a percent of face value since yesterday's close. All of these bond prices are down since yesterday. What must have happened to interest rates yesterday? All the bond prices are down, so interest rates had to have been up yesterday. Does that make sense? Okay. And then finally, that last column, we have the asked yield. That's the yield to maturity based on the asked price. And if we had one more piece of information, the date of this quote, we could actually compute that on our own and verify that those numbers are correct. We don't have the date of this quote, so we can't do that. But you could, if you found one in the Wall Street Journal, you could compare this ask yield that gets printed versus what your calculator says, and they should be the same. Okay, let's see. One thing I want to point out here, the yield and maturity on these. What do you notice happens as the date gets further and further out? Does it get higher or lower? Yeah, it gets higher, and that's not by accident. We'll get into that here very shortly. Questions? Okay, now let's talk about inflation and interest rates. It's so much fun now to be able to give these talks now that we actually have inflation that people care about, because people would sleep through this previously. But here we've got two kinds of returns we want to talk about. We want to talk about real returns and nominal returns. Let's start with nominal returns. Nominal returns are all about the returns based on the number of the unit or the units of currency that you receive as a result of having made the investment. If you invest $100 and you get $110 1 year later, that means that you've had a nominal return of 10%. 10 divided by 100 is 10%. Now, let's ask this question. Do you know how much you can buy with 110 compared to what you could buy with 100 a year earlier? You don't. We're missing a thing here, and that thing is called inflation. And if we had inflation that was greater than 10%, guess what? You're actually able to buy less as a result of having made that investment. So we have this thing called the Fisher effect. And the Fisher effect gives us the relationship between real returns and nominal returns. Let me talk about real returns. Those are the returns that represent the increase in your ability to consume as a consequence of having made this investment. And so if you invest money at the beginning of the year, enough money to buy 10 pepperoni pizzas, and at the end of the year you have enough money to buy 11 pepperoni pizzas, then you've got 11 minus 10 divided by 10, or a 10% real return on your investment. Did we discuss how much the pizzas cost? No. Did we discuss what units of currency we're using? No. Could have been Chinese yuan, could have been US dollars. It didn't matter. So what we're talking about purely with real returns is the increase in your ability to consume for having made the investment. Okay. By the way, what's the goal of investing? We are not only delaying consumption, but we are hoping to be able to consume later for having consume more later for having forgone consumption now. Does that make sense? Okay. So how are these things related? Well, there's this formula, 1 plus big R. Let's talk about what big R is. Big R is the nominal rate. Big R is the nominal rate. Little r is the real rate. Little r is the real rate. And then we have H. What do you think H stands for? Yeah, H stands for inflation. Now you say, wait a minute, why don't we use I? Any ideas? What else do we have in finance that starts with an I?
Interest rates.
Yeah, interest, and people get confused. Now, there is one other thing people tend to use here, and Dr. Whitty will use pi. He'll use pi. And I tell him, Doug, you got to stop that. And here's why. Because there are a certain amount of students who will say, 1 plus 3.14, right? Because they're thinking of a different pi. So that's why I use H. That's why I use H. Okay. Now, these are all going to be in decimals. They are not in percentages, they are in decimals. So write that down, all in decimals. Now notice if I expand this out, 1 plus R is equal to 1 plus R times 1 plus H. Now hopefully some of you remember a little bit of your algebra. It's first, outer, inner, last, FOIL. First, 1 times 1. And then the outer. And then the inner. And then what? Yeah. So now I've got 1 plus big R is equal to 1 plus H plus R times H. What can I do with the ones? Yeah, they go away, right? And so I can do that. And now I've got big R is equal to H plus R times H. That's an exact formula. That's an exact formula. However, people will do this approximation down at the bottom, which is just R plus H. The problem is that it ignores R times H. Never, 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 never in my class should you use the approximation. Never, 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 Mr. Ali, ever. Ms. Pomeroy. Never use the approximation, never. Should you ever use the approximation in my class?
Never.
Never. Okay. Now, here's the reason why. When interest rates are low and inflation rates are low, that approximation is probably fairly good. It's good enough for you and your friends after work having beers on the back of a cocktail napkin. Perfectly fine. But what happens when, by the way, when inflation goes up, what tends to happen to people's desire to, they kind of go together. Well, anyway, so what we're seeing here is that these things, if inflation goes up, this thing gets pretty big comparatively. And so that's why we never, never, never use the approximation. Just in barroom conversations would be the only time you'd want to do that. Questions? Should this big formula on the top be on your note sheet? Absolutely, it should be. And you may have to rearrange it. For instance, you may have to say 1 plus R is equal to 1 plus big R divided by 1 plus H. You might have to do that. Who knows? You might even have to do 1 plus H is equal to 1 plus big R divided by 1 plus little r. True. You might have to do any of those. By the way, how do I solve this for H? I just subtract 1 from both sides. How do I solve this for the real return? I just subtract 1 from both sides. Questions? Okay, now we're on to the term structure of interest rates. And once again, this is usually a boring part of the talk, but something exciting is going on right now. We're going to talk about that. 95% of the time, the top picture is what we see. That's an upward sloping term structure. What does that mean? It means that interest rates for loaning out money on the short term are lower than they are for loaning out money on the long term. 95% of the time, that's the way it works. And that's good because that's how banks make money. Banks get your deposits, which are short-term money, they get them for a low interest rate, and they turn around and they loan them out on the long term, which is a higher rate. And as long as we have that upward upward sloping term structure, then banks are in pretty good shape. What happens though is if we have this downward sloping term structure, now banks are paying more for their short-term money than they're getting for the long-term debt that they have out there. For example, I've got a money market fund right now that's paying over 4%, and my mortgage rate's only 3.375. I've got 30-year money at 3.375. They've got short-term money at 4 point something, right? Does that make sense? So that's a bad thing. That's like buying apples for 25 cents a piece and selling them for 23 cents a piece. It's a bad business model. And every time that we see this swap in the term structures, we see bank failures. Someone in here asked me about Silicon Valley Bank the other day. Yeah, Silicon Valley Bank, what were they doing? They were taking short-term deposits and they were investing on the long term, usually like government bonds, things like that. Well, now they're having to pay more for the deposits because interest rates are up, and it basically put them in a bad situation. And every time we see this downward sloping term structure, we see bank failures. Do you think we've seen our last bank failure for this round? No, we have not. Okay, now let's talk about what gets added together to come up with this term structure of interest rates. And it's like a layer cake. And at the base, you've got your real rate. And that is the increase in your ability to consume. And we have no theoretical reason to believe that people demand more real rate for a 30-year investment than they do for a 1 year. We have no theoretical basis for that, so we just assume that is flat all the way through. And then on top of that, the second layer of this cake is the inflation premium. Basically, to that bottom level, we are adding our expectation for inflation. We're adding our expectation for inflation. And so if our expectation for inflation is flat, then those two parts are flat all the way through. If our expectation for inflation is going down, then we'll actually see that those two pieces together slope downward. Now you could actually have a slightly sloping downward first two layers, and you could still have an upward sloping term structure because of the third layer of the cake. And that is the interest rate risk premium. We know that the longer we have that money out there, the more interest rate risk there is, the more risk you take on, the more return you require. And so that's why that if we just look at interest rate risk premium by itself, it would look like this. It would be upward sloping by itself. And in fact, it would be upward sloping enough that even if there were a slight slope down on that inflation premium, we could still have an upward sloping term structure. And it would all be good. By the way, the time over here on the left is like 0 years, and the time on the right is 30 years. So that's the usual scale we put on these. Okay, now, why is the top what normally happens? Well, normally we're expecting steady inflation. Normally we're expecting steady inflation, and so that's why we see this thing looking fairly flat for the first two layers. What happens though when we have about inflation like we're having right now is that central banks raise short-term rates. Central banks raise short-term rates, and so that left-hand side gets kicked up. Now, as a result of kicking up the short-term rates, by the way, how does kicking up short-term interest rates kill inflation? Any ideas?
Reduces your demand factor.
Yeah, why?
It makes it more hard to borrow, right?
Well, it makes it harder to borrow, but it also, so here's an example. My grandfather, I don't think he borrowed any money after 1947. So I was talking to him, the year was probably in the late 80s, and he had a 1979 Pontiac Bonneville. It was ugly. I said, Grandpa, no, this is actually the late 70s. And he had a Chevy Impala back then, a 66. I said, Grandpa, why won't you buy a new car? He said, do you know how much money I'm making on my cash down at the bank? He said, it'd be insane to go out and buy a new car at this point. So he was behaving exactly as Paul Volcker, the head of the Federal Reserve, wanted him to. He was foregoing consumption, putting his money in the bank instead. Remember, inflation is too much money chasing too few goods. So there's two ways to fix that. Either number one, we can take money off the street, or number two, we can magically start producing 20% more stuff people want to buy. How easy is making 20% more stuff people want to buy? It's not easy, right? So it's the pulling the money in off the street that's going to help you get your inflation down. Now, what does that lead to, though? This inflation premium, we know that current inflation is really high, but we're expecting it to go down. Does that make sense? And so right now, if you looked at the inflation premium portion of the term structure of interest rates, it's going to look like that second picture, because people are thinking that they're going to get this inflation under control. Are they? I don't know. But that's the thought right now. And inflation does seem to be ticking down. Does that mean prices are going down? No, it just means they're not going up as fast as they were. Okay. So when we have the bottom picture, the interest rate risk premium upslope is not enough to overcome that downslope in the expected inflation premium. Questions? Okay. Now let's talk about the determinants of bond yields. We've already talked about the term structure of interest rates. Those are the three layers of the cake: the real rate, the inflation premium, and the interest rate risk premium. And that is, by the way, we figure the term structure of interest rates based on United States government zero coupon bonds. And so basically what we're doing is they actually will break apart government bonds and sell the coupons as separately individual things, and then the face value. So it's called separate trading of registered interest and principal, or strips, which is what they call those. And so what we use is the yield on all those strips going out 6 months, 1 year, 1.5 years, and on until we get out to 30 years. And that's what gives us that term structure of interest rates. Now, if you remember, we think the United States government is default risk free. And so that term structure of interest rates doesn't have any default risk in it whatsoever. And so that's something we're going to have to add on. If we're looking at a bond yield, we have to look at how risky the borrower is. The riskier they are, the higher the default risk premium. So you could have two firms in exactly the same economy, one's riskier than the other. That default risk premium is going to make their yield to maturity on their bonds higher. And then we have the taxability premium. Earlier we talked about the discount on the municipal bonds because they aren't taxable. Well, another way to look at that is that you have to pay a premium if the bond is taxable. And so we're going to tack that on there too. And the final one your book calls the liquidity premium. Liquidity, if something is liquid, it means you have the ability to sell it at or near the full market value in a short amount of time. So if something is liquid, you can sell it at or near the full market value in a short amount of time. And so if something is liquid, it meets that definition. If something is not, then we say it is illiquid. And it turns out that having illiquid assets is something we don't like to do. It actually adds to the risk. And I'm going to give you a very concrete example here. A young man has $25,000. He doesn't think he's going to need it for another 5 years. And so what does he do? He goes to his broker and he says, I need to invest this $25,000 over the next 5 years. What do you have? And the broker says, well, he says, I've got these two bonds. They're otherwise identical. This one is publicly traded. This one is not. And the young man says, okay, which one pays more? And the broker says, well, the one that is not publicly traded pays more. Now, why does it have to pay more? Because it's got this illiquidity problem. If it's not publicly traded and the young man needs to sell it, he's going to have to find someone who wants to buy it. That's not easy. And so the young man says, well, I'm not going to really need this money for the next 5 years, so this liquidity thing is not a big deal for me. I'll go ahead and take the higher return on the non-publicly traded bond. And so the broker tells him, great decision. By the way, the broker would have told him great decision either way, right? Because he's getting a commission. Okay, so the broker says, great decision, sells the young man the not publicly traded bonds. That night, the young man goes home to his girlfriend. And his girlfriend says, I've been thinking we should get married. The young man says, I've been thinking that too. And then the young lady says, I've been thinking I need an engagement ring. And the young man says, I've been thinking that too. And then the young man, it starts to sink in. He's like, He says, where are we going to get this engagement ring? And she says, Cartier. You guys know Cartier? Is it cheap? No. He says, He says, how much is this engagement ring going to cost me? And she says, $25,000. He says, I have some great news. I have $25,000. He says, all you have to do is wait 5 years, and I can buy you that engagement ring. How do you think the story ends? Yeah, the young man, I try to put it more optimistically, the young man gets a new girlfriend, right? Because he's not going to get to keep the old one. Does that make sense? So that's the problem with these illiquid bonds. You may think that you don't need the money, but if you do, you're in a world of hurt. They have to pay you a premium for taking that risk. Questions? Okay. Now we are on to stock valuation. So if we think back to the very last slide of chapter 4, which I know you all looked at, it says that the price or value of anything is the present value of the expected future cash flows discounted at a rate appropriate to those cash flows. So what are the cash flows that you expect to receive from owning stock? 2 times you get money from stock. One starts with a D. What is it? Dividends. And what's the other one? Yeah, when you sell it, right? And so basically, if we could just find the present value of the dividends and the proceeds from the sale of shares, then that would tell us what each share of stock was worth. So here we go. We are going to start with our very basic idea we just said, and we're going to come up with our ability to value this. And it says the price at time 0, that means the price today, is equal to D1. D1 is a dividend to be received 1 year from now. D1 is a dividend to be received 1 year from now. Divide by 1 plus R. Why am I dividing by 1 plus R? Because present value is equal to future value. Divide by 1 plus R to the T. T here is 1, so it's actually just 1 plus R. So we're going to take that dividend we receive at the end of the year, divide by 1 plus R, and we're going to do the same thing. We're going to sell the stock at time 1, and we are going to collect P1. And the present value of that is P1 divided by 1 plus R. Now, it's fairly simple to figure out what D1 is. Usually we can do a pretty good job of figuring that one out. But the question is this. Can you tell me what the price of a stock is going to be 1 year from today? If you can, come to my office, we'll get rich together, right? I've not met anybody that can do this. So, not a problem though, because here's what we can do. Instead, what we can do is say that the price at time 1 is going to be, we could actually just advance all of those times in the first formula by 1, and it gives us P1 in terms of D2 and P2. So problem solved, except for one thing. How many of you can tell me the price of the stock 2 years from today? If you could tell me at 1 year, I would be amazed. If you could tell me at 2 years, I would be absolutely floored, because it's harder to forecast things further into the future. If you don't believe me, just look at the weather forecast and then track how accurate it was. They said 2 weeks ago we're going to have this. It hardly ever comes to pass. Can they tell us what's going to happen today? Usually. Can they tell us what's going to happen tomorrow? A little less often. Can they tell us what's going to happen 2 years from now? No. Which is why I think it's crazy that we're spending trillions of dollars on this climate remediation stuff based on a weather forecast that's 1,000 years out. How accurate can that forecast be? Does that make sense? We can't forecast more beyond a week. Okay, but I digress. Back to the story. Now, we see the problem. Any time that this model actually has the price of the stock in it, we're going to have a problem. And so what we're going to do then is we're just going to keep pushing that out by doing this over and over and over again. And basically, we're going to end up with the price at time 0 is equal to the present value of D1 plus the present value of D2 plus the present value of D3, plus the present value of D infinity plus P infinity, the present value of P infinity. Now, let's talk about the present value of P infinity. P infinity. So it's going to be 1 plus R to the, what's T here? Infinity. 1 plus R, as long as R is positive, 1 plus R to the infinity is a huge flipping number. Does that make sense? What do I get when I divide anything by a huge flipping number? 0, right? It's basically so small that it doesn't matter. And so as a result, we could say, hey, all we really have to do is look at the present value of all the expected future dividends. We don't even have to look at that price because we pushed it all the way out to the end of time, and the present value of anything at the end of time, boop, 0. Does that make sense? Okay. By the way, this is a great multiple choice question. And I'll say, what's the value of a stock? And the answer is simply the present value of all the future dividends. But students, for some reason, will want to say it's the present value of the future earnings. That's only true if the earnings are all paid out as dividends. Because what we're looking at is the expected future cash flows. Until you sell the firm, or until you sell the stocks, you're not going to get the value of the monies that haven't been paid out as dividends. Does that make sense? Okay. By the way, most firms do not pay out all their dividends, pay out all their earnings as dividends. So we can come up then with some basic models for valuing stock based on the patterns that their dividends follow. And we have 3 patterns we're going to talk about here. The first is 0 dividend growth. If 0 dividend, so it's not 0 dividends, it's 0 dividend growth. That means that the same dividend gets paid over and over and over again. And if you remember back to our chapter 4, which hopefully you went back and reviewed, we could actually value that as a perpetuity, which is a set of identical cash flows that goes on forever. So that's our first model. The second is going to be the constant growth dividends. And so we're expecting these dividends to grow at a constant rate. We could actually value them as a growing perpetuity, as we shall see. And then finally, we end up with this weird situation of differential dividend growth. And that's where the dividends grow fast at first, and then they end up growing more slowly later. Now, remember, I told you that the stock price is the present value of the expected future dividends. But some stocks don't pay dividends at all. Do they have a positive stock price? Yeah. How can that be possible if they're not paying dividends?
Future values worth more?
Okay, so you're thinking in the right. Remember, I said it's the expected future dividends. What do we expect these firms to do with their dividend policy down the road? Do we expect them to always hold on to zero? No. It turns out that companies go through like a growth profile. So in the beginning, the company is probably not bringing in enough money to even fund all of their positive, all their good projects. Let's call them good projects for now. Positive NPV is what we would call them once we've taught you that. So the firm has these projects that are going to increase shareholder wealth, but they don't have enough money to fund them. So they have to go outside for that money. They either have to borrow it from a bank, they have to issue bonds, or they have to issue stock. Now, at some point, the money coming in is exactly enough to meet the needs of all the good projects. And we, at that point, we stop getting money from the outside and we start funding our stuff internally. Now, this is a very simplified argument, but that's what we're looking at here. Now, eventually, though, what do you think happens to the growth opportunities at firms as they get older? They start to slow down, right? They start to get smaller and smaller, the growth opportunities. So I'll give you an example. Back during the late 90s, there was this company called Cisco. And Cisco was making routers for this new thing called the internet. And their growth was just amazing. And everyone was assuming that Cisco would grow forever and ever that way. Is that possible? No. At some point in time, everybody's going to have a router. Does that make sense? Everybody's going to have a router. At that point, the growth opportunities for Cisco are much lower than they were earlier. Okay, so when you go through these different phases of life, at some point, you start to have more cash coming in than you need to reinvest in the firm. At that point, you start paying dividends. At that point, you start paying dividends. And so that is why we say we could have these companies that are not currently paying any dividends now, but they have a positive stock price, and that's because we expect at some point they will start paying dividends. Some real examples. Microsoft. Microsoft went a long, long time before they started paying their first dividend. Apple. Now, Apple really has two lives. So there's the first life that would nearly ended, and then Steve Jobs came back. And so let's talk about the second life. In the beginning, of course, they're not paying any dividends, but then at some point, I think it was after Steve died, I think they pay a dividend now, small, but they pay one. And so that's the cycle that companies go through. Questions so far?
Why would a company pay dividends instead of just retaining it for their own investment?
Okay, so keep in mind whose money it is. Who's it belong to? The shareholders. And so the shareholders, the goal is to maximize shareholder wealth. And so we should only invest in projects that are going to increase shareholder wealth. At some point, the money that's coming in is so big that it not only covers that ability to invest in those projects, but there's money left over. Who does the money belong to? Who should the money go to? Shareholders. Does that make sense? Now, what's a bigger problem? When people, they get to that point where they've got enough funds to cover their growth needs, but they hold on to the money anyway. And just like when you guys go out on the town and you've got, so let's say that Ms. Black and Ms. Minahan go out on the town. And they're going to the same, I assume you guys are like party clubbers, so I'm going to throw that out there. So, but Ms. Black has $300 in her pocket. Ms. Minahan has $100 in her pocket. Who do you think is more likely to buy more drinks? Even if they have the same, let's assume that their height, weight, and their livers are exactly the same, it would take exactly the same amount of alcohol to get them to their happy place. Ms. Black is more likely to buy more drinks simply because she has more money in her pocket. Does that fit with your human experience? Yeah. Okay. Do you think companies are any different? No. In fact, companies are just groups of people, right? And it's even worse than Ms. Black and Ms. Minahan, because in this case, this is money that it's actually your money, right? What if you had a pocket full of someone else's money? Oh, you're making it rain up in here, right? Does that make sense? So what are managers? They're managers with pockets full of other people's money. And so if they're sitting around there and they're holding on to the cash instead of paying it out, then pretty soon they start to think of extra nice things they could do for themselves. For example, I was at this company and we had free coffee. It was Maxwell House, which is like drinking drain cleaner. It's awful. And then the cash starts to pile up. We get, and this is back in the late 90s, early 2000s when the K-Cup, that was brand new, right? They were like $3 a pop. And they bring that in, and that's going to be our new free coffee. And so we went from like 15 cents a cup for coffee that the company was paying up to like $3 a cup. Oh, it was good. But whose money was it? The shareholders. The shareholders would have been better off if we had paid that money out rather than rewarding ourselves with hazelnut mochaccino frap or whatever. Does that make sense? Okay, so we want the managers to pay out if they're not investing in positive NPV projects. So let's talk about our zero dividend growth formula. As I already mentioned, we can value this as a perpetuity, which means a set of identical payments that goes on forever. And we know that the formula for perpetuities is PV is equal to C over R, where C is that repeating amount of cash that you get every period, and R is the required return. And so I can just find the present value by doing that math. This is actually, by the way, so let's put this in the stock terms. The price today is equal to that annual identical dividend divided by the required return. So if it's paying out the same dividend every year, which is by definition zero growth, then we can price it this way. P sub 0 is equal to D over R. And you say, wait a minute, how many stocks actually pay with no growth in the dividends? And the answer is an entire class of stocks called preferred stocks. Preferred stocks, unless something goes horribly wrong, preferred stocks pay a fixed dividend over and over and over again. Common stocks, that dividend can go up or down, but on preferred stocks, it stays the same. And so this is actually the formula that we use. In fact, we rearrange it and say R is equal to D over P0, and that's how you could figure out what the return is on owning a share of preferred stock based on today's share price. So this is actually used in the real world. Questions so far? Okay. Now let's talk about constant dividend growth. Constant dividend growth, those dividends grow at the same rate through all time. So every year, 4%, 4%, 4%. And we can value a growing perpetuity like this. Present value is equal to C1 divided by R minus G. Now there's a couple of changes. First of all, I've thrown this G in there. What do you think G stands for? Growth. By the way, R and G must be in their decimal form. R and G must be in their decimal form. And the other thing that we notice here is that there is now a subscript after C. And the reason is that no two of the cash flows, the dividends in this case, are identical because this thing's constantly growing. So we have to nail it down. Which dividend are we talking about? And so we can actually come up with this formula. P sub 0 is equal to D1 over R minus G. Now I want to point something out to you here. What happens as the growth rate increases? Does present value, the price, go up or down? It's actually going up. So think about this. So on the bottom, we've got R minus G. The greater G is, the smaller that thing on the bottom is. When I divide by a smaller number, I get a bigger number. And so what we see is that if a firm's growth rate is higher, it will have a higher price. Everything else equal. Does that make sense? Okay. Now, you also have to be careful here because we've got this D1 and that's the dividend 1 year from today. But a lot of times they give us the dividend today. So they give us P sub 0. And we need to know which they've given us. Because if they give us P sub 0, or if they give us D sub 0, we're going to multiply by 1 plus G to get D sub 1. Because after all, this thing grows by G percentages a year, right? So 1 plus G multiplied by D sub 0 should give me D1. And so you can actually substitute this thing down here at the bottom and have P sub 0 is equal to D0 times 1 plus G divided by R minus G. Now, here's what, remember I tell you that a lot of times it's not math that messes people up on exams, it's English. And so let's talk about how these things will be worded on the exam. If it says just paid, that's D sub 0. If they say last dividend was, that's D sub 0. If they say next dividend, that's D sub 1. Or in 1 year, that's D sub 1. And so basically, if it has the smell of past or present, then it's D sub 0. If it has the smell of future, not more than 1 year, then it's D sub 1. What if I said it's going to pay out $1 starting 2 years from now? What would that $1 be? D2, right? Okay. I guarantee you should have this on your note sheet. I guarantee you should have both these things on your note sheet. And if you have trouble with algebra, you should go ahead and do that substitution and have both versions on your note sheet. And you should probably have this on your note sheet of how to figure out which is D0 and which is D1. Now there's one more thing I want to point out. Look at this to the right of the formula. It says R must be greater than G. What happens in that formula if R is equal to G? What's the bottom? 0. And if you divide anything by 0, what do you get?
0.
Oh, no, you multiply anything by 0, you get 0. You divide anything by 0 and you get?
You get a number.
Yeah. Okay, so it depends on who you ask. If you ask an engineer, they will say infinity. If you ask a mathematician, they'll say undefined. Undefined. If you ask a mathematician, they'll say undefined. So we can't do that. Now, what if G is greater than R? Then that thing on the bottom turns positive or negative? Negative. And when you do this, assuming that, and by the way, dividends can't be negative. Are you going to, is the company going to send you a bill for negative? No. And so if this thing on the bottom, if G were greater than R, then the stock price would be negative. Can stock prices be negative? No, because of limited liability, stock prices can never be below 0. Questions? Okay, well, I will see you on Tuesday when we will finish teaching you all the calculation stuff you need to know to do your homework.